Every now and then, the story of an enormously successful tech company being worth hundreds of millions of dollars or even $1 billion makes the news. These stories are a hallmark of our new technology buoyed economy. So magical and highly valued are such companies that insiders have a name for them: unicorns. Only about 100 such companies exist worldwide, and a majority of them are in the US. But as with any such too good to be true financial phenomenon, is the warning of what happened last time and what is likely to happen in the future. What goes up must come down, or perhaps what inflates into a bubble must eventually burst. That's the case my guest Doug Henwood makes in his new article for The Nation, entitled Age of the Unicorn: How the Fed Tried to Fix the Recession and Created the Tech Bubble. Doug Henwood is a political economist, author of After the New Economy, editor of Left Business Observer. Welcome to Uprising, Doug. Thanks for joining us. Well, just to get a sense of what companies are considered unicorns, you cite the famous ones that were unicorns before they were famous: Facebook, LinkedIn, Twitter, Groupon, etc. What is the financial definition of a unicorn?
It's a company that's worth $1 billion. The way that's figured is if, say, an investor puts $100 million into a company and gets a 10% stake in it, that's figured to be $1 billion. We don't really know that they could actually sell the other 90% for 900 million, but that's the rule of thumb that people use. It's just a way of being gee whiz when you have a unicorn.
So are these so-called unicorns artificially inflating the economy? And what does the Federal Reserve have to do with it?
Well, the Federal Reserve, starting after the financial crisis, when interest rates got down to 0% and the economy was not taking off, decided to do something called quantitative easing, which meant basically they bought gobs of bonds, treasury bonds and mortgage bonds, in a hope to get some liquidity into the economy and stimulate things. Most people who study this think that it helped a little bit, but not very much. Maybe added a couple of percentage points to economic growth over the last few years, maybe took a fraction of a percent off the unemployment rate. So, but when fiscal problems when fiscal policy has been very tight, this was the only stimulative game in town. But one thing it did was certainly to stimulate the financial markets. The Fed pumped over $4 trillion of liquidity into the markets, and that led to a very buoyant stock market, at least the last couple of months, to buoyant real estate markets in cities where finance is big, like on the coast, New York and in California, but also did also stimulate investment by venture capitalists in tech startups. And this, unlike the boom in the late 90s, doesn't involve the public so much. In the late 90s, the public bought all these crazy dot-com stocks, and when everything went bust, millions of people lost lots of money. So their retirement accounts wiped out, or their savings really, really reduced. This time, it's mostly institutional investors who put money into venture capital funds. So when things go bust, the immediate circle of people that's going to be hurt will be relatively small, although this money has really inflated real estate markets in New York and especially San Francisco. That's, I think, the real world effect of a lot of this has been to do that, to price people out of those areas.